Enron, the rise, the illusion, and the collapse. Enron was once one of the most admired companies in America. It was called innovative, revolutionary, visionary. At its peak, it was worth more than $70 billion. Then, in 2001, it collapsed. Not slowly, not gradually. Suddenly, thousands of employees lost their jobs. Investors lost billions. Retirement accounts were wiped out. One of the largest corporations in the United States vanished almost overnight. How does something that large disappear? To understand the fall, we have to carefully examine the rise. Part 1. The rise. Enron was formed in 1985 through the merger of two natural gas pipeline companies. In the beginning, it was straightforward. It transported natural gas through pipelines. It earned predictable revenue. But the 1990s brought deregulation to energy markets. That change allowed energy to be traded more freely. Executives at Enron saw an opportunity. Instead of just transporting gas, Enron began trading energy contracts. It positioned itself as a marketplace. It matched buyers and sellers. It created contracts for electricity, natural gas, and eventually many other commodities. Soon, Enron expanded into broadband trading, weather derivatives, and international energy projects. The company no longer described itself as a pipeline business. It described itself as an energy trading innovator. Wall Street loved the story. Quarter after quarter, Enron reported strong growth. Revenue appeared to surge. Analysts praised management. The stock price climbed steadily through the 1990s. By 2000, Enron's shares traded above $90. Executives were celebrated. Business magazines ranked Enron among the most innovative companies in America for multiple consecutive years. Inside the company, the culture rewarded ambition and intelligence. Employees were ranked aggressively. Performance was constantly evaluated. Compensation was tied heavily to stock price. Everything revolved around growth. But growth can be engineered. Part 2. The accounting. To maintain its image of unstoppable expansion, Enron adopted aggressive accounting techniques. One of the most important was mark-to-market accounting. Under traditional accounting, a company records revenue when cash is actually earned. Enron did something different. When it signed a long-term contract, sometimes lasting 10 or 20 years, it estimated the total profit expected over the entire life of that contract. Then it recorded a large portion of that estimated profit immediately. Future projections became present earnings. If the project later underperformed, adjustments were often delayed or minimized. On paper, earnings appeared smooth and strong. But accounting alone was not enough to hide deeper problems. Enron also created hundreds of special-purpose entities. These were separate legal partnerships used to move debt off Enron's balance sheet. Here is how it worked in simple terms. If Enron had debt from a project that was not performing well, it could transfer that debt into one of these outside entities. Technically, the debt still existed, but it no longer appeared directly on Enron's main financial statements. Investors looking at the balance sheet saw lower liabilities. The company appeared healthier than it truly was. As long as the stock price kept rising, this structure held together. Confidence supported everything. Part 3. The culture. Accounting methods do not operate in isolation. They reflect incentives. At Enron, compensation was heavily tied to stock performance. Executives received large stock options. Employees were encouraged to hold company shares in their retirement accounts. Short-term price appreciation became the central objective. Internal competition was intense. Employees were ranked against each other. Those who underperformed were often dismissed. This created pressure to deliver results. When pressure combines with complex financial engineering, ethical lines can blur. Risk-taking was rewarded. Transparency was secondary. The company appeared brilliant from the outside. Internally, the structure was increasingly fragile. Part 4. The cracks appear. In early 2001, analysts began asking deeper questions. Enron's financial statements were complicated. Cash flow did not align cleanly with reported profits. The partnerships were difficult to understand. Skepticism increased. In October 2001, Enron announced a significant write-down related to its off-balance sheet partnerships. Soon after, it admitted it had overstated earnings by nearly $600 million over several years. Confidence began to evaporate. The stock price started falling. When the price fell, the special-purpose entities that depended on stock value began to unravel. Many of those structures were backed by Enron shares. As the shares declined, collateral weakened. The system that once amplified growth now accelerated collapse. Credit rating agencies downgraded Enron's debt to junk status. This was devastating. Enron relied on short-term borrowing to operate. Without strong credit, lenders pulled back. Liquidity disappeared. In December 2001, Enron filed for bankruptcy protection. At the time, it was the largest corporate bankruptcy in U.S. history. Part 5. The human cost. Numbers often hide the human dimension. Thousands of employees lost their jobs. Many employees had significant portions of their retirement savings invested in Enron stock. When the share price collapsed from over $90 to near zero, retirement accounts were destroyed. Some employees were even restricted from selling during critical periods, while executives had already sold substantial personal holdings. The impact was not abstract. Families were affected. Careers were disrupted. Trust in corporate leadership was damaged. Public outrage followed. Part 6. The aftermath. Investigations revealed widespread accounting manipulation and misleading disclosures. Enron's auditing firm, Arthur Andersen, was implicated for failing to properly challenge the company's accounting practices. The firm was later convicted of obstruction of justice, and although the conviction was eventually overturned, the reputational damage effectively ended the firm. Several Enron executives faced criminal charges. Convictions followed. The scandal led to sweeping regulatory reform. In 2002, Congress passed the Sarbanes-Oxley Act. This legislation increased corporate accountability, required stronger internal controls, and imposed stricter standards on financial reporting and auditing. Corporate governance in America changed significantly as a result of Enron. Part 7. The lessons. Enron's story is not simply about fraud. It is about incentives, complexity, and trust. First, complexity can conceal risk. When financial statements become too difficult to understand, that opacity can mask underlying instability. Second, incentives drive behavior. When compensation depends heavily on stock price, pressure builds to sustain appearances. Third, leverage amplifies outcomes. As long as confidence remains high, leverage accelerates growth. When confidence breaks, leverage accelerates collapse. Fourth, diversification matters. Employees who concentrated both their employment and retirement savings in a single company faced catastrophic loss. Finally, trust is foundational. Markets operate on confidence in reported information. Once that confidence erodes, recovery becomes extremely difficult. Enron did not fail overnight. It failed gradually beneath the surface. The collapse simply revealed what had been building for years. Conclusion. Enron once symbolized innovation and modern finance. Its executives were admired. Its stock was celebrated. Its growth was praised. But the appearance of strength was built on fragile foundations. In the end, transparency was sacrificed for growth. When scrutiny arrived, the illusion could not withstand it. Enron was a giant. Then it was gone. And its collapse reshaped corporate America, regulatory policy, and investor awareness for decades to come.